Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, once again, we're talking with Doug Heagren. Hey, Doug.
Hey, Kirk. Good morning.
Good. Well, glad to have you back on. This is going to be another fascinating episode. We've gotten a lot of positive feedback from our listeners on many of the recent episodes. So I'm glad. I appreciate everyone's feedback, and don't be afraid to send it in because we always love feedback. So let's just dive right in. So today, lots going on in the world. Let's start with what's actually going on with the markets, and then we'll dive back into the inflation issues that are going on. So I've been getting a lot of comments here that everyone's thinking, oh, it's a bear market. The markets are just gonna go straight down, and yet they've been doing really well this past week. So what do you make of this, Doug?
Well, isn't that always the case? When everybody expects the worst, it's going to be better. I mean, that's the typical trends, right? When everything looks like the sky is going to fall. I mean, look at what Warren Buffett just put a bunch of more money into the markets and bought up some things. He's not looking short term; he's looking long term. But when everybody's selling, the old saying is that's when you should be buying, right? But as we've talked about, is this a short term thing or is this a long term thing? And with a lot of fundamental and paradigm shifting going on in the way things have happened in the economy, again, like anything, you should be investing more for a long-term mindset because there's still a lot of things to play out here.
Yeah, I would agree. And it's interesting because I think perspective is really important here. If you think about like the low point, let's take the NASDAQ, for instance, because, everyone was interested in FANG stocks and technology prior to 2022. And, I look at that and say, wow, it was down like close to 30%, halfway through the year. Well, that's terrible, right? It's down 30% in 6 months. You'd say, wow, that sounds like a crash. Well, it wasn't really a crash. Now it's only, as of today's taping, it's down only about 20%, give or take. Wow, it's really done well. Well, this is something we talk about on the show a lot, and I wanted to bring it up today because it's so important that we all have this recency bias in our brain, right? We all have cognitive biases. It's how our brain works, right? It's how we get through the day. If we don't have cognitive bias, you wouldn't even make it through the day, right? Your brain would explode from overstimulation. And what it does in many ways, in some ways it protects us, from getting eaten from saber-toothed tigers, thousands of years ago. But now some of those processes actually harm us in our investing. And one of those things is looking at recency bias and assuming that everything is going to play out continuously from here to the end of time in the same way that it is now, right? The market's going up. Well, it's always going to go up. We'll just buy and forget, right? Or the market's going down. Oh, let's freak out. It's going to go down forever. It's going to go to zero. And it's just not the case, right? So if you look at this year, we mentioned this before a few weeks ago in the episode where we talked about bear markets and how they work. This is what we would call a bear market rally, which means that there are points in time in a bear market where the markets go down a lot. And then at some point you run out of sellers and people just say, oh, I'm done selling. I'm just going to sit there and wait. And then the market starts to come back a little bit. And then people say, oh, I got to get in. I don't want to miss the bottom. And then they get in, they push it up. And then that stops. And then it goes down again. It's very normal behavior. And I'm not saying I'm predicting the future price of the market. I'm just saying this is what is historically expected to be normal for a bear market. So I'm not saying you should buy or sell here because I think it's anybody's guess, but you should recognize that the markets could go up, right? They could go up a little bit more. There are certain markers that technical analysts use to determine, when the trend changes from down to up. And, we could certainly talk about that if you want, Doug. But I think it's just important to recognize we are coming up with some of those inflection points where, if it breaks through there and continues higher, then we're back into a bullish stance. So, I'm always proven to be wrong. There are times where I could say, you know what, I'm wrong about this thesis. Let's change our tact. But I think it's just important to recognize the thinking behind it and why things are happening the way they are and what you should expect, so that you're not baited to jump into the market and say, oh my God, I'm missing the bottom. And then right at that moment, the market turns around and goes down again, right? It's just something to be aware of. So when you're looking at your investing portfolio, you can at least think about this and decide, is this is this the time where it's going to change and start going up? Or is this a time where it's just baiting people in and then it's going to go down again? So just something to think about. If you're not thinking about that question, then you're really not thinking about investing the right way. You should always be asking yourself that question. Risk management should always come first before performance. If you like a stock, you think it's going to go through the roof, great. Do your risk management first. And if you still think it's going through the roof, then you can invest in it. But if you never stop to do risk management, you're just going to end up losing money hand over fist over time. You need to do that first. That's what all the professionals do. They look at what's the most I could lose. Best traders in the world, they look at that first and say, all right, my stop loss is X. No matter what happens, if it hits this, I'm out. I don't care what my thesis is, I'm done. So you just need to know, right? And maybe it's, I don't care if the stock goes to zero. I like it, and it's well, actually, is a good example. Look at cryptocurrency, right? I think that's a good thesis to use with cryptocurrency. You have to assume it's going to go to zero. Maybe it won't. I don't know. Maybe it will. I have no idea. But I would make that assumption going in that it's very possible it could happen. And if you're comfortable with that, then anything else is going to be gravy. So I think you have to think that way with any investment and just understand, like, what outcome is going to prove my thesis wrong. So maybe the stock goes down 5%. And you say, all right, my thesis was, it's going to go straight up from here, and it didn't. Okay, I need to sell because my thesis wasn't correct. I need to come back and reassess and determine, did I do something wrong, or maybe I'm just early. But that's how you should think about investing and trading. Is you always have to ask yourself the question, how am I going to know when I'm wrong? And then where is that point, right? Where I can say, all right, I'm wrong at this point. If you answer those two questions, I think you'll be in good shape. So Doug, what are your thoughts based on that?
Well, I think there's, as always, there's quite a few things to pick out of there. I think, if you go back to the beginning of what you said, will stocks continue to go up? I mean, in general, in a bubble, yes, I think they will. And here's why I think they will. Because it basically comes down to, if inflation goes up, then prices go up. Prices go up, revenue goes up. Revenue goes up, earning goes up. Earning goes up, effectively dividends and growth go up, and that just creates greater wealth across the board. But that doesn't mean that it's going to go up in short-term cycles, okay? And so it can take long time for you to make money, depending on what's going on in those cycles. We talked about it before. There's been 13 years or more where the markets were negative, and you can't get time back. Lost money's lost forever, right? So if you lose that money, you don't just get back to where you were and feel you're whole. You have to get back to where you were and put in all the money that you would have made during that time. Okay, so firmly believe that there is more to be gained by avoiding losses than picking winners. And that's really where the smart money tends to go. It's only in the Twitter sphere that you hear a lot of the advice out there that say it's always about keeping your money invested all the time because it's only going to go up and you're never going to lose. Look at all these times. I mean, I'm sorry, but if you lose 13 years of growth, I mean, that's 1/3 to 1/4 of your entire main investing period. And I like how you talked about crypto. So January 2021, this was a time when there was a massive money supply. And this is what we've talked about. Huge injection of monetary supply out there. And it's got to take time to reabsorb itself. Okay. If you take, here's a great example I heard from someone from recently, an economist, Brian Westbury. I thought it was well positioned to explain what's going on. If you take apples and you've got $10 and you want to buy 10 apples, each apple's $1. Okay. If all of a sudden you inject $20 out there against 10 apples, now each apple costs $2. Now take it a step further and pull away 5 of those apples. Okay. Now, not calculating the quick math in my head here, but you're talking about basically what, $4 an apple, if I think I've got that right. Yep. So you're talking about a massive increase in the price of things, which goes back to the inflation that we're seeing here. The goods got restricted. The money flow got released. To give an example of that, and going back to what went well during a lot of these lockdowns is with this money supply, a lot of technology did well, crypto being one of those things. In January 2021, Jack Dorsey auctioned off an NFT for his first tweet, and I believe it went for about $2.9 million. Now, the individual that bought it wanted to share the wealth and put it back out there for people to be able to now have a piece of Jack's first tweet. They were expecting it would only bring in around $10,000. I believe the final price that it got on the resale was about 260. Okay. If that doesn't tell you what was happening there with regards to the enormous amount of free money that people were just willing to spend that really wasn't theirs. You know, you look at the boats, you look at the supplies people bought. They called them stimmy boats, right? People took this money, they spent it on things, you know, lots of goods, one-time use. There is billions of dollars sitting in cash out there right now that needs to be reabsorbed. And because of that, and because we still have mainly a supply issue that has been exacerbated by a number of forces that continued, like the Russian invasion of Ukraine, you're starting to see an issue. You're continuing to see an issue of prices being really high, inflation being really high, and because of that, it's driving earnings continuing to be really high. And I think because of that, in the right area, those earnings are going to continue to be strong. And if those earnings are strong, I think we may continue to see some positive forces on the markets that will continue for a period of time, especially if we cross some technicals. But guess what? This money is being reabsorbed. And when it does, like you said, it's going to come a limit in which it will continue to be able to support high prices, high earnings. And when that happens, recession is coming. I don't know when. Some people predict 2023. Some people project 2024. Guess what? By the time it happens, it'll be too late. And there will be a snapback along the way, most likely, that's going to take, and unfortunately, some victims with it if you're not preparing for risk right now.
How do you like them apples, huh, Doug?
Exactly.
Well, I appreciate that perspective. I think that's really important to recognize. I think that we don't talk about that enough on the show, so I appreciate you bringing it up. Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. I do want to bring up a quote here because I think I've been reading a lot of research recently just to get the professionals' perspective. I think a lot of them are coming around to kind of our opinion on this show. I'm sure they're listening to the show and saying, hey, what do they think? But realistically, I want to share some of them because, I mean, we've been talking about this for a while, and I think they put it in a good perspective. So there's a analyst for Credit Suisse, Zoltan Pozsar. I'm probably going to botch the last name, but here's one of the quotes. What he says is, getting right where inflation goes from here is basically a matter of perspective. Do you see inflation as cyclical, i.e. a messy reopening after COVID exacerbated by excessive stimulus, or structural, a messy transition from a multipolar world order where two great powers are challenging the might and hegemony of the US. If the former, inflation has peaked. If the latter, inflation has barely started. Now, I mention this because I think it's important to recognize, while we have an opinion here on the show, and everyone here listening also probably has an opinion about the world, I would imagine, that we can always be wrong. And I think I bring this up because there really are two paths here. And while I certainly think my thesis is correct, I'm always open to being wrong. And I know where I'm going to be wrong. We just talked about that earlier in the show, is that you have to know when you're wrong and at what point, what markers are going to say, this is the point that's going to tell me I'm wrong. And, you know, when I put together my thesis, I was very fully aware of what those markers were. Now, I think this puts a finer point on it, which is basically, you know, if you think that the markets are just going to go back to normal, you have the cyclical perspective, which is COVID messed things up. You know, we had the market sell off a little bit, you know, excessive stimulus, as Doug was talking about. You know, supply, it doesn't even get into supply chain, but basically you've got this messy reopening, which we all recognize, right? The bullwhip effect in effect. You know, all these tech stocks that went through the roof after COVID, and now they're coming down because, you know, people just aren't using them as much as anymore. I was talking to a supply chain expert this morning, and he was telling me that, you know, a lot of this expansion that happened is now getting pulled back, right? With a lot of these different companies, people overspent and now they're underspending, right? Using all this technology to work from home. Well, now people are going back to work. They don't need it anymore. So these companies aren't getting the same revenue that they got before. So I think that's certainly one opinion. It's not my opinion, because I think that misses all of this other stuff on the second part, which is structural. Now, Zoltan doesn't give an opinion necessarily about where he thinks it's going, but I think that if you understand the deeper aspects of our economy, it's hard to miss this structural part. You know, when they talk about a messy transition from a multipolar world, where two great powers are challenging the might and hegemony of the US, I think it's more than that. I think it's just, you have effectively, the global economy was structured to take advantage of cheap labor in Asia, places like China, India, Vietnam, you know, in different aspects of the economy, people were taking advantage of that cheaper labor. And that's how economies work, right? You find cheap cost of goods and you sell them to people who want to buy them. And hey, it's cheaper. I'll buy twice as many, right? That's kind of how the economy works. Well, now that that's being disrupted, the globalization that's been happening for 20 years is now reversing, because we have to, right? So that TV that you bought for $500 is now going to be $1,000. And maybe a few years from now, maybe it's 1,500, because you can't get it as cheap as you could, because before, the supply chain was built to be efficient, not to be resilient. And now they have to be resilient, which means it's going to cost more money, which means instead of outsourcing that to China, now you have to outsource it to Mexico, which may be closer globally to the US, but at the same point, maybe it's going to cost more to produce it in terms of labor and other things. So now that TV is more expensive, but it's not going to go back to $500, because that globalization effect that happened is reversed, and we're not going back there. And I think this is the hard thing for people to grasp. They just think, oh, we're just going to go back to normal. The prices of goods are not going down. Maybe they do at some point because of a massive depression or severe recession. That's possible, but we're not going back to the way we were. What will probably more likely happen is they'll stagnate, right? They'll be higher, but then they'll sit where they are. But now wages have to go up because everything's still more expensive, but you don't have any more money. So you've got this back and forth that goes on in the economy. And this is why you have volatility, because global corporations cannot predict a lot of their need. What's the supply and demand? I don't know, right? What's the demand? We have no idea. It could be high, it could be low, but they don't want to not have enough goods. So they overbuy, and then they have to liquidate, which either way, they're losing money. So they have to decide which kind of money they're going to lose. But the point being is, this, in my opinion, is structural. I don't see how you can see it any other way, because the supply chain is a structural problem. Reversing globalization is a structural problem, and it doesn't happen overnight. It's going to take years for this to play out. And then you throw in China potentially invading Taiwan, forget about it. Like the supply chain is going to be broken for a decade. So I think you have to just think about how all of this is playing out. And are we going back to a quiet period where there's no friction in, global politics? Okay, maybe things settle down a little bit, but all it takes is a stupid move by a politician to flare things up, and all of a sudden, now you've got a bigger problem. That bullwhip just gets bigger. That back and forth effect. So I don't know. Just reading this quote. What are your thoughts, Doug?
Well, I mean, if I'm trying to summarize, do I think it's going to be inflation is going to be short term or long term? Can I say yes? I because I
Yes,
think
you
we've
can.
got because I think we've got two different problems here. I think yes, from the short term perspective, inflation is cyclical and short term from this monetary supply, right? All that money got produced. It's going to get reabsorbed over time. And I believe that is going to help to bring down some of those short term issues that created too much money to buy too few goods. But the problem is that as that starts to reabsorb, we still have to face things that you were talking about. But really, during the lockdowns, there was a complete stop in investment in material technology. Okay. So yes, we had the Zooms of the world. You had the Amazons of the world. It was great for retail, right? But a lot of these retail companies, they overstaffed. You go in, somebody was talking the other day, you go into Home Depot now and you feel like you're at the Four Seasons because you got service like you've never had before because there's too many people sitting around, right? They really ramped up to be able to support the retail needs that were there that are starting to pull back, okay? But at the same time, what didn't happen? We didn't have any investment going on in finding new energy reserves, okay, during that time. So now when we need to have the supply of energy to be able to create the things that we need to do, to ship, to build, not the TV is not just about cheap labor. The TV is also made of plastics, right? It's made of petroleum, heavy material goods, and they're more expensive to do now. So now companies are going to find it harder to go and do and create and build new things if they don't already have the infrastructure built, because of the cost it takes to break ground and do those things. Now you add in these geopolitical forces, right? I mean, who knows what's going to happen there, but I think that there has been a significant loss of trust over the last couple of years in this frail supply chain that does have a lot of risk of getting worse. I mean, Russia invaded Ukraine. I mean, look at McDonald's. They left Russia and lost everything. They got nothing for their investment. Now you look at this, you look at the realization of continued geopolitical forces that happen in China. It's not a free market economy. They want to pretend to be one, but Jack Ma made a couple very benign comments about the government and disappeared for 6 months. Okay.
He's on vacation.
What did you say?
He's on vacation.
He's on vacation. Elon Musk does more than that in a single tweet, right? So I think there's become a huge distrust there, and that may exacerbate the investment or the continual relationship that we're going to have, which could bring more back to the United States and in terms of our technology and the world wanting our technology. But guess what? We have outsourced all that. So it's going to take time to bring that infrastructure back here if that's the direction it's going to go. So we're kind of stuck between two things: goods that aren't available, supply chain issues, more than two things, too much money out there. And I guess what? I think what this is going to lead to, Kirk, something we've talked about. Guess what? Stagflation. We're going to have inflation here, but it's going to still be there because oil prices will stay up, material goods prices will stay up, goods will still be hard to get. We're starting to see some turnover at the bottom. Credit card numbers, are going up a little bit, but at the top, they're the ones spending. So there's billions of dollars sitting in cash and checking accounts that people still have to spend. So as we start going into 2 years from now, 1 year from now, whatever that might be, and we start to get to a point of possible recession, prices won't be going down as we go into it. And I think, and again, our opinions are just our opinions, but I do think that we are in the next 12 to 24 months, we're going to, it's kind of like, and this is another Brian Westbrook, I want to give credit where it's due. You break your leg, the first thing they do is give you heroin. Or I'm sorry, morphine. Hey, they're both
Hey, what kind of doctor are you going to, Doug?
They're both opiates, right? So they get,
Oh God, that's awesome. Thanks for that,
hey,
Doug.
if you can't get the morphine, you go to heroin. Hey, listen, no, you go to the morphine and it feels good, right? You don't realize that you've got a broken leg, right? You're just going on with your life. Even when you first break or have an injury, your endorphins hit. All of a sudden, this morphine starts to wear off. And guess what? The pain starts to be felt. And we're going to feel some significant pain that's going to be coming. We're not there yet because everybody's still living on the morphine of the stimulus.
I'm going straight to crack, Doug. So heroin is my thing. I like the crack.
Hey, wait, there's the highlight of today's show right there.
That was that. We'll pull that clip for for the social media. So I want to go to the next quote, which won't be as much of a highlight as that one, Doug. But I think it's another good one we can talk about, which is same from Zoltan. I think it was a good perspective. So central banks went from waging a war against deflationary impulses coming from globalization of cheap resources, which is labor, goods, and commodities, to cleaning up the inflationary impulses coming from the complex economic war. Think of the economic war between the US, China, and Russia as something that will weaken the pillars of a globalized, low inflation world described above. The process will be slow, not sudden, but it will be certain, where ongoing economic tits for tats will have the potential to drive more and more inflation. So I think this quote really kind of dives into that the messy structural factor, which is, I mention it because I think it's important to pull out that a lot of people for the last 14 years thought that, oh, we're going to have high inflation right around the corner. Oh, we're printing a ton of money. And I talk about this over and over and over again. Oh, we're printing a lot of money. It's going to cause hyperinflation. That's actually not it. The reason they were printing money, and I think this gets into like second level thinking, which I think is a term that I forget who came up with it, but I think it's really important to understand. There's first level thinking, which is, oh, A happens, so B happens. Second level thinking is, well, if A happens, then B happens. So then what's going to happen to C, right? It's taking a step back and saying, what else is this effect that we're not immediately thinking about? And so a lot of people were thinking about printing money equals inflation. Printing a lot of money equals hyperinflation. But we never saw that. And the reason is central banks effectively were printing money to fill a hole, right? So 2008 was a hole, right? Asset prices went down, real estate, people lost tons of money. So the Federal Reserve effectively printed money, right? As they enabled QE to come in and stimulate the economy, effectively printing money, and it boosted asset prices around the world, right? That's effectively what it did. But all it did was fill a hole, right? The hole was lost money from real estate. So every time they print money, most of the time it's to fill that hole, right? So if you think about this deflationary impulses coming from globalization, we had a lot of deflationary forces coming at us in the last 20 years. Technology is deflationary. People don't realize this. Technology, in part, is really deflationary. Perfect example. I mentioned this in a prior show. I bought a computer in college. It wasn't top of the line. It was like a step down. It was the best value because you're getting a great computer and it cost a lot less money than the top model, but it was the best value. I found over the years that getting that second from the top or somewhere in there model of a computer, it's the best value because it lasts the longest, because it's going to stick around because it's still a good computer, but you're not overpaying for like gaming stuff, but it's a really good computer that'll last you a long time. I mean, I have a laptop that's lasted me 10 years, shocker. I think the only reason I have to get a new one is because it won't accept the new version of Windows, but it's still good. It's still good. It's still fast. It works. My point is I've been paying the same amount for that computer for the last 20 years. I've been paying $2,000 and you still get a great computer. And people might think, yeah, but you can get one for $500. The $2,000 computer is still a good value. And yet the computer I got in college was like an Apple II GS. It was a great computer back then. It was, for Apple, I think it was top of the line, but it was a fantastic computer. I'm still paying $2,000 for that same type of model, which means that computers are getting better and we're not paying more for them. So in effect, that's really deflationary because the output is a lot better than what you're paying in. And if you look at across the board, prices have come down. I remember as a kid, we had one TV in our house. One. That was like the family TV. If you wanted to watch something as a family, you watched on that one TV. Now people have a TV in every single room, and they're cheaper than they were back then. It might have been like $2,000 for like the family TV for like a reasonably nice one. Now you can get one for a few $100, and you can have one in every single room. So technology is really deflationary, and that has caused the goods and services to go down in price over years and allows us to buy a lot more of it, right? So we had that deflationary force coming at us. And of course there was inflation too, but the point was that was being balanced and ended up being a low inflationary world, which is really kind of this Goldilocks period for the economy, because if you have low inflation and it's more or less predictable, it allows companies to predict and spend money for the next decade, which helps the economy grow. It's predictable. It helps companies predict their earnings. It's all a good thing. But when you have deflation, or if you have high inflation, which is what we have now, it's highly unpredictable, right? So the economic war between US, China, and Russia, which is certainly picked up steam in the last few years, it weakens the pillars of that globalized low inflation, because we used to go to China and Russia, well, mostly China, for cheap goods. But now companies have to decide, is China worth the risk? And in my opinion, I think they were being stupid before, because they're thinking, oh, well, we know they're stealing our IP. We're actually going to make a deal with them so they can take our IP. But you know what? We're going to get cheaper goods, so it'll help us, which is short time. It's really kind of short-term thinking, right? Japan is a great country when it comes to long-term thinking. They don't look in quarters, they look in decades. Whereas in the US, we look in quarters. So they're thinking, well, all right, I can save a few bucks for this quarter and get my earnings up. Long-term is going to be a problem. But companies just willingly went along with it, knowing the risk. And now that risk is coming to the forefront, and now they have to decide, oh, wow, I made a big mistake. What am I going to do? And if they regionalize their outsourcing, they're just going to have to put it in different places around the world. But those places are going to be more expensive. Going to Canada, going to Mexico, Vietnam, India, Australia, wherever they're going, Eastern, well, I don't know if they're going to Eastern Europe now, but either way, wherever they're going is going to be more expensive than where they are. And the reason they're in China is because it was probably the cheapest goods for the best quality they could get. And now they're going to have to find other sources, and that's going to be expensive. So what that means is that the cost of goods and services are going to stay high. And unless we magically solve these disputes we have with Russia and China, costs aren't going down. We're not going back to the old ways. And I think people have to accept that. And what that means for your investments, that's what we're here talking about. So Doug, what are your thoughts based on that? On that, how does that kind of play out in your thinking?
Well, I love that you talk about perspective, because I'm going to use fuel prices as an example of that. Like, we talk about deflationary. I mean, as much as people are complaining about gas prices, and yes, they've come back down a little bit, my opinion, I believe it's temporary. And for a number of reasons, one of which I'll get into, is that if you take a look at what gas prices are right now, let's say they got to close to $5 a gallon. Right? They've been $5 a gallon or close to it before, if we go back about 10 years, 10, 15 years ago. If you look at the price of gas over the course of like the last, 30, 40 years, it really has kind of fluctuated between like $1 and $4 for most of the time. Compare that to milk, right? A half gallon of milk went from like 10 cents a gallon up to, $5, $6. If you want organic milk, you're paying $6 for a half gallon of milk. Fuel, because these oil companies got so efficient about being able to extract petroleum out of the earth, it has kept petroleum as effectively a deflationary good, and we've gotten spoiled by it. But guess what? Like I said, they have not invested in it in the last several years. We had tons of oil companies that went under when oil prices plummeted during COVID as part of one of the, the victimization of organizations. And now, without that new technology, it has created unfortunately a supply and demand issue on petroleum as everything kicked back in. And it's only going to get worse. Uganda president came out and was talking about how in the next 20 years, they expect the population of Africa to double. Okay. These developing worlds, they need energy to grow. Okay. And they can't, and what we learned over the last 24 months, and especially since Russia invaded Ukraine, is guess what? Renewable energy didn't work, right? They need real cheap energy. And what happened with that real cheap energy? And he said, look, we're going to grow, and you can't expect our economic prosperity to be stifled because we're going to be doing all these clean technologies. We need cheap energy. We need it now. How did you, America, how did you, Western world, get to where you were? Okay. How do you expect us to do it differently than you did? Because we need to get there too. And I think that demand for petroleum in goods and services is going to continue to go up. Another thing I think is really key here that you talked about, Kirk, is the monetary supply and kind of how come all this QE stimulation back in 2008 didn't lead to inflation. A lot of it has to do with policy. The Federal Reserve did inject, the government injected through QE1, QE2, QE3, QE4, billions and billions, trillions of dollars. But the Federal Reserve went to the banks and said, sorry, you can't give it out. So they massively restricted monetary supply. So what did they do differently? Well, COVID came out. They injected the stimulus and said, look, help these people. And the bank said, we can't. We're handcuffed. We're tied. What do you want us to do? You know what? Remove all those restrictions. Boom. Massive money supply this time that went out there. So it wasn't about the policy of creating the money supply. It was the removal of the restrictions that made the M2 money supply available. All of a sudden, like I said earlier on, you have the same amount, if not less, apples available and a lot more money to buy them. And that creates a massive spike in prices. So I think, it's going to take a long time for that amount of money supply to reabsorb itself out of the economy. And nobody's really 100% sure how much liquidity is sitting out there. And I want to talk about one quick thing here, because a lot of two things, actually. People talk about GDP and they're worried about debt and GDP. The interesting about GDP, it's very misleading, right? GDP only counts the goods you buy. It doesn't count all of the purchases and production of every stage of the process to create it. So when you buy that TV, that's GDP. But what about the manufacturing of the chips inside of it? What about the assembly of that product? What about the shipping of that product? Those dollars are not counted there. And so, when we talk about, these ratios against the GDP and concerns about the economy, I think that's one positive is, hey, our GDP is healthier than the GDP numbers actually show. So again, not everything's doom and gloom here. There are some positives. And again, remember that, hey, the United States economy, for all you want to say about it, is still probably one of the healthiest and most resilient in the entire world. And I don't think that's going to change.
Yeah, I would agree with that. I think there's a lot of the confusion going on right now about, whether we're in a recession or not. We certainly found some comedy from the Biden administration on that. But, technically we might be in a recession, but, I think the confusing part, and I don't typically defend politicians, but I think the confusing part is that, while we might technically be in a recession, there's a lot of aspects of it that are not recessionary, which is, we have a really low unemployment rate. And so while we're not maybe in a recession now, if you look at the inverted yield curve, which has gotten deeply inverted and probably even will continue to be more so, one of the challenges with that is that is predictive of recessions. Historically, it's unflawed for predicting recessions. I think the issue is when. So typically there's 6 to 18 months from when you have an inverted yield curve. I think, quite frankly, we've kind of been in one for a while, so it's a question of, are we going in, are we going out? But the Federal Reserve is inverting it because they're raising it on the short end, and the long end is not taking hold. So, but I do want to point out one thing, because I'm going to put this in the show notes, is if you look at gas prices, you were talking about gas prices earlier, and we had gas at $1, $2 normally, in normal times, and it went up to $5. Right now in Europe, just to put things in perspective, Europe has always been more expensive than the US. I remember traveling over there when it was, $1 and change for a gallon here. and it was like, I forget, it was like $1 to $2 a liter over there, and of course it's like close to, it's like 3.875 liters per gallon. So you're looking at close to 4 to 1. So right now, Russia's gas prices are 3.25 per gallon. Okay, that's the low end. If you look at something like France, Spain, Portugal, Italy, Austria, you're looking, it's right around $7 a gallon. So even though we have right between $4 and $5 a gallon right now, I think is where it is for most places in the U.S., it's still more expensive in Europe. Europe actually is going to have a lot more problems with, with gas price and energy prices, no matter where they go. And until we make nice with Russia, I think there's going to be a lot of problems over there with energy prices. But, I think there's some good and some bad to that. I think the good is it'll accelerate their thinking, because I think they were adamant that they didn't need to find alternative fuel sources, and I think now they realize they do. So all of this is deglobalization, and it's inflationary. It's not going away. People are realizing they need to be more resilient, which is a good thing, right? Companies always want to cut corners and try to be as efficient as possible. Not cut corners in a bad way, but they're trying to lower the cost of goods and increase profits. That's what companies do. But I think if they're thinking like the Japanese think, which is in decades, then the strategy is a lot more based around how do we make sure that anything that happens doesn't disrupt our economy. And I think it'll take a few years to get there. So I think I still fall, if you take that quote, in the structural camp. And it's going to take a lot to convince me otherwise, because I just don't see how those dynamics are going away. We could certainly, have a little bit of peace with Russia and China in the short term, but it doesn't change the fact that these companies still have to make that decision to structurally change their own economics, and that affects us all. So we're going to wrap it up here in the interest of time. But Doug, where can people find more about you?
Hi. Thanks, Kirk. Douglas Heagren. You can find me at ProCollegePlanners.com. You don't have to pay full price for college. Most people do. There are discounts out there. If you think you make too much to get those discounts, that's one of the greatest myths. Find out how to get the discounts, not just how you pay less tuition. How you pay can also affect that. And so look us up, ProCollegePlanners.com. If you've got a child that's going to school in the next 4 years, even if they're right on the cusp of going this year, it's not too late to figure out how to learn the rules of this game and win it. We'll tell you the truth about how college works.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.